let's get into the stock picks that you of your choice. Vincent, you could tell us, but could you also tell us the basis for your choice?
Okay. The picks that we have right now are essentially more, I guess, of a shorter horizon. We're not looking for multi-baggers, if you will, and set against a background of a cautious economy, bearing in mind that stagflation scenario is a worry. The liquidity run right now may not last, as I was going to allude to the fact earlier on that that the easy monetary policy today you see here may be derailed because inflation is becoming a bigger and bigger threat. And when that happens, you will see liquidity being set off from the market. But for the meantime, I think there are some interesting plays that markets will be keen to have a good eye on. And most of the picks that we have generally are companies which are benefiting from very strong earnings momentum, and of course their consensus beating momentum. So having said that, let me just give you our highlights on our top picks. We have Public Bank, EMW, Anju, Hub Sing, and Alam Maritime. In terms of the picks, we have picked 2 large cap companies and the rest of the small caps. Now, if you talk to most investors, the large cap companies are generally well rewarded or fairly valued in most cases. The deep value is in the small caps or mid caps at this point in time. But because we're still very defensive in our stance, I would like to have a good mix in terms of representing the top picks. So Public is more for safety. Now being the largest, being the bank with the largest market cap right now, obviously is gaining a lot of traction there. We also like it for the good sustainable yield. And I think banks will be one of the sectors that probably should bring in decent earnings growth next year compared to decelerating growth in a lot more other sectors. Now moving on to, should I elaborate?
Yes, go.
Okay. Moving on to UMW. It's one of those interesting stocks to look at because it's a twin play between oil and gas and autos. Now, autos is one of those sectors, apart from steel, that we like a lot because it is one of the sectors that is going to beat consensus by a great deal. So I think UMW is not going to be indifferent. UMW is trading at only about 10 plus times earnings, forward earnings at this point in time. And I think that there's a lot of room for upside in the sense that historically the company trades about 13 times earnings. And based on our earnings forecast, we are about 15% ahead of consensus. And even with that, we've already only assumed that auto earnings probably will be only up by 10 to 15% compared to last year. But given the trend that we saw in the last 2 quarters, I think the earnings momentum is sustainable for at least for a few quarters, and that will obviously impress the market a fair bit. And on top of that, being a large cap company, UMW is one of the rare ones which provide growth visibility because of the oil and gas initiatives. Combine that with a good dividend policy. The company has a policy to pay off at least 50% on net profits, which provide a fairly good yield base with growing prospects. Moving on, Anju we like for 2 reasons. Number one is that I believe that second quarter numbers will again surprise on the upside. First quarter had already surprised. It's partly because of inventory effect, i.e. companies have been benefiting from having low inventory cost, which been carried forward in today's inflationary environment. But beyond that, this company, which trades at single-digit PE, promises a good transformation story. It's the first company, steel company, that's going to adopt what you call the mini blast furnace in Malaysia. And that brings a big structural change to the company in ability to lower cost, and also in the ability for it to produce more value-added items, such as flat products against today, which is predominantly long products for Anju. The next one that we have in our books that we like is Hub Sing Consolidated. Again, trading at single-digit PEs. It's more of an opportunistic buy call because it is trading at deep value to its breakup value. the breakup value runs to at least 5 ringgit per share. But the story there is, again, it's a resource play, benefiting from the rise in CPO prices. It owns 51% of Hap Seng Plantation. But what has not been known until recently is a big run-up in fertilizer prices. Hap Seng is one of the key distributors of fertilizers in Malaysia and Indonesia, primarily potash. That's been one of the key earners for this company. This division, you're going to see probably a tenfold increase in earnings for this year compared to last year from very modest base. And Hap Seng is also a play, incidentally, is also an East Malaysian corridor play. And we saw in the headlines today about Sabah, right here, Sabah looking to get more attention from Barisan National on the development. And of course, with greater development there, it will help the likes of Hap Seng, which also has a presence in property development, and also they have operate quarries in Sabah. The last one I'd like to highlight is on Alam Maritime. It's obviously one of those well-known mid-cap oil and gas stocks. It's trading at perhaps a little bit higher in terms of PE compared to our the other two mid-cap stocks I've been talking about. But it's interesting because oil and gas theme will rage on, and we believe that oil prices will continue to be quite lofty to support the growth in E&P activities, not just in Malaysia but regionally. This is one of those companies which is growing at least 30%. And it's not just growing, it's growing also because it has a very interesting leaseback strategy which allows it to finance off balance sheet. It's looking into two potential new areas, such as, for example, rig ownership, which provides about 20% return, about 5-year payback period. And also is bidding for an underwater maintenance contract. So we believe that one of the initiatives is going to gain traction, which provides fairly good momentum to the earnings.
I'd like to check with you to expand on these companies. For a public bank with still a very high rate of growth for its deposit base, would it be, do you expect it to be able to sustain a high dividend yield? Because wouldn't it need to support the capital adequacy ratio in view of the high deposit rate growth?
Not at this point in time. Right now, the risk-weighted capital ratio is very high. It's well above 10%. And at this point in time, we can see that the capital base can support growth for the next few years without them to revisit on their dividend policy.
But in terms of the capital relative to their deposit base, that ratio will be declining in view of the very high growth of the deposits, right? Of course, now they still have a very high cushion, but at some point
at some point in time, but it's not in the immediate future.
Okay.
So it's not a worry at this point in time for the next couple of years.
For Hap Seng, I was thinking of, or even of Anju, do you get a sense that with all this inflation, and you would think that those people who are in the intermediary as intermediaries, their raw material costs would actually go up, but now it would appear that they are passing on their costs very well, maybe more than 100% of their costs. I mean, of course, as corporates, they are doing a very good job, but do you think are they overdoing it in passing on their costs?
Well, I mean, it's all boils down to competition and industry practice. I don't think those boys are deviating from industry practice. Yes, obviously they're making super profits today, but so are a lot of their peers. So I think these two companies will continue to make very, very extremely healthy returns so long as we have an inflationary environment, and that's probably going to continue for easily for the next few quarters.
Since your pick includes UMW, and this experience of stagflation actually affects consumer spending rather than interest rate in terms of the structure of the inflation. But there is enough consumer spending, you think, that a consumer product would still do very well.
Yeah, actually, thanks for bringing this up. I think on UMW, again, our view is that it's a momentum play at this point in time. We expect the first and second quarter numbers to be fairly strong, but we note that obviously consumption trends will come off. For example, if you look back in 2006 when Malaysia experienced a bit of a runaway inflation situation, you find that consumption falls, not so much for FMCG products, but for durable goods, and auto sales actually fell significantly or noticeably. I think the same situation will apply here. We will see, I think, a noticeable drop in trend lines in terms of sales trend for autos, which will obviously moderate UMW's growth. But the oil and gas division, which accounts for about up to 40% of earnings today, will rage on in terms of delivering growth. And what's interesting about UMW is that because of the new ventures they've locked into in China as well as in India, those engines are only going to start firing next year, not this year. And that will provide them with the incremental growth that they need.
This sounds like a GLC which has done quite well.
Yes, definitely. But I guess in terms of GLCs, UMW is a quasi GLC in that sense. But maybe if I can revisit on Hap Seng, maybe if I can just highlight on potash itself. Potash prices have gone up from below 200 US per ton. Today it's about 700 plus. Expectations are it for to reach about 1,000 US dollar per ton. And if that happens, obviously Hap Seng, like Hap Seng, is going to make a killing in terms of the gains. Although it's just a trading division.
If it marks up above 100% of the cost. On the oil and gas industry, what do you think is the reason that the oil and gas sector has not really performed in the last 1 year? Is it due to some doubts as to their earnings growth?
No, I think there are two reasons. Number one is mean reversion in the sense that the share prices have done extremely well. Don't forget last year. And you see, because of the huge outperformance, the stock performances get a little bit more tired. You see a bit of reversal of that. The second reason for that is mainly because most of these oil and gas stocks are mid-cap stocks, mid-cap to small-cap stocks. And you see that this kind of environment does not favor mid and small-cap stocks. And that's why you can see a lot of deep value be emerging in this segment, principally because a lot of foreign funds have pulled out of small caps or mid caps, not just in Malaysia but regionally because of liquidity considerations.
So you think that sell down from the top may have been overdone at this time?
Yeah, obviously fundamentally these companies are trading well below their fundamental values.
I think we have yet to see the first oil and gas company to report their results this season. Because yesterday's Epic's results were not too great, right?
Epic's results are more unique, and it relates to added administrative cost.
Okay.
But not if you look at the underlying revenue growth, it's growing at a fantastic pace. And I would imagine for most other oil and gas companies, I think cost management will be a lot more tighter. Obviously, costs will go up in tandem with rising revenues, but you will find that I believe that margins will be maintained, if not improved in some cases. For example, if you look at Alam Maritime and even Petra Pradana, so, the providers of offshore vessels, you find that when the lease period ends, on renewing the leases, these guys get a lot more higher charter rates, which will more than offset higher cost of deliveries.
Right. So for oil and gas, your top pick would be Alam Maritime.
That's one of our key topics. And I guess my point here is that so long as this kind of companies continue to deliver 30% earnings growth clip and prospects continue to be good, eventually the valuations will catch up.
To what extent do you think Alam Maritime is a competitive company, and to what extent is it enjoying a Petronas license?
Obviously, it's very dependent on Petronas patronage today, but the good news for a lot of oil and gas companies today is that with Petronas' ongoing efforts to groom these companies, I think there's a chance that these companies will be one of the few sectors in Malaysia that can be groomed to compete regionally. But at this point in time, obviously a lot of these companies still have to prove themselves.
Okay. Thanks, Vincent.